We thank and appreciate Doug and Wayman from Carrollton Bank for this webinar. So I'm going to turn it over to them, and then we hope to have a question and answer. So whenever one of you are ready, we'll get started.
Okay, well, good afternoon, everyone. I'm Wayman Williams from Carrollton Bank, and I also have Doug Goodwin, one of my colleagues from Carrollton Bank.
Good afternoon.
We are here to go through this home buying webinar with in conjunction with Money Smart Month and the St. Louis Financial Empowerment Coalition. This is one of over 65 free Money Smart financial education events that are occurring all over St. Louis metro area in partnership with financial institutions, nonprofit agencies, libraries, schools, churches, and local government. Money Smart Month is a community education initiative sponsored by, again, the St. Louis Regional Financial Empowerment Coalition with in-kind support from United Way of Greater St. Louis. The event's also made possible by our founders, which include Stifel Bank, Commerce Bank, First Mid Bank, Montgomery Bank, and many others. Please visit moneysmartstlouis.org to learn about other personal finance events, the coalition, our sponsors, and our work. Please also note that at the end of this class or this webinar, there's going to be a link in the chat for a survey. Please take a look at that. That link has already been copied, so you'll have information there to complete the survey. And just a brief introduction, again, I'm Wayman Williams with Carrollton Bank. My primary role is a home loan officer along with community development officer. I've been in the mortgage industry for about 15 years and pretty well versed in all aspects of it. Feel free, again, anytime throughout this, if you have questions, please put those in the chat and we'll be able to answer those. And I'll allow my colleague Doug to go ahead with his introduction and we'll get started. Doug?
Hi, I'm Doug Goodwin. I've been in the mortgage industry for about 20 years. I do both residential side and commercial side. And I look forward to giving this class and helping out Wayman here. So Wayman, take it away.
All right, thanks everyone. So we'll go ahead and get started. And again, this is Carrollton Bank's home buying workshop here. We'll cover a number of topics throughout this presentation from pretty much all aspects of the home buying process. So feel free again to put any questions that you have in the chat, or if there's anything immediate, let us know and we can address that at that point. Okay, so throughout this webinar, we're going to cover mortgage loan basics. We're going to talk about our FHA loans, features and benefits. We'll also talk a little bit about conventional loans. We'll talk about down payment assistance program and just overall explore the home buying process. Okay. So first question here is, what are the steps to obtaining a loan? One of the first things that you want to do is you want to know your financial picture. And typically that financial picture starts with your credit report. Each individual is entitled to one free credit report per year. Okay. And here's some information in regards to that. So again, you're entitled to one free copy from each of the 3 reporting agencies within the 12 months. Here's information pertaining to that. The 3 reporting agencies are going to be Equifax, Experian, and TransUnion. Okay, so those are their direct contact phone numbers for each individual reporting agency, as well as the link for annualcreditreport.com. So one thing I just want to point out in regards to the free credit reports, they do not provide a credit score. What they do is they provide information in regards to trade lines that are current, trade lines that you've had before. They give an overall picture of your credit report, but they do not give you a score. So the benefit of this credit report is that you're able to take a look at that and see that the accounts that are reporting on the credit report are in fact accurate. Okay, so any credit report that's going to involve a score, you're going to have to pay for that. And typically that fee, I believe now, is about $25 for a full credit report, including a score. Okay. Who uses credit scores? At this juncture, I would probably pretty much say anyone. You have your credit unions and banks, of course, they're going to use those credit scores for approval and for loan terms. Also insurance companies, where there's going to be auto, life, or health insurance, they're going to use your credit score, and that's going to determine the premium that's associated with those particular policies. Landlords, utility companies, cell phone companies, they use your credit scores to determine whether or not there's going to be a deposit and how much that deposit is. Employers even use your credit score for the hiring process. So understand the importance of your credit score. It is looked upon truly as an indication of your responsibility. So that's why you have those four or those different entities that use your credit score. So pretty much anyone that asks you for your credit information, you can take for granted that they're going to use that information to gauge your credit worthiness, your responsibility, and things like that. So while talking about credit scores, understand what that information contains. You don't want to pass your credit information to anyone in this day and age where there's a lot of fraud out here in the world. You want to protect that information, but just understand who uses that information. So here's some factors that make up the score, your credit score. So 35% of your credit score is based on your payment history, which is your past payment history. 30% is based on the capacity, which the capacity is going to be the amount of credit that you have. 15% is going to be based on the length of time that you've had credit, how long you've had it, and your total credit history. 10% is going to be based on the accumulation, which is new credit inquiries that you've had recently. Inquiries are any time someone has checked your credit, it's going to show up on your credit report as an inquiry. 10% is going to be based on the types of credit used, whether it's installment, revolving, mortgage credit. So the good thing is to have a nice mixture of credit. You don't want to have too much credit, but you would need to have a mixture of revolving credit, which is going to be credit cards. Installment loans are going to be loans that have a set payment every month. Examples of installment loans are going to be auto loans. Most mortgages are installment loans. They only change based upon the taxes and insurance. So that's looked upon as an installment loan as well. Any questions about anything so far? Okay, so we'll move on to this next slide. This is really just a slide that contains information as far as getting your ducks in a row. If you're looking to purchase a home, here are some things that you would want to do to kind of prepare yourself. And I would take a look at the pre-qualification checklist on the right side. Basically, you're going to provide your personal information for the pre-qualification process. You'll have a loan officer such as myself or Doug. You would complete the loan application with us, meaning you'll update your personal information, your employment information, income, assets. The liabilities will pull directly from the credit report, and that is going to be a part of the pre-qualification process. Okay. And here it is. The pre-qualification process is going to tell you a number of things. First of all, it's going to tell you how much money the lender will loan you. It's going to also tell you what purchase price you can afford. It's going to tell you how much of a down payment you will require. It's also going to tell you your estimated total monthly payment. Okay. Also, it's going to tell us as a loan officer what loan program is going to fit you better. There are different types of loans, which we'll discuss a little bit later in this presentation, but you have your FHA, you have your conventional loans, USDA loans, they're going to be VA loans for veterans. So the pre-qualification process also allows the mortgage professional to tailor a program for you. It's going to help us to figure out which program is going to work best for you. Now, this last point in red, this is not a guarantee. It's a process that we have to go through, but it's not a guarantee because the expectation is that you will maintain your employment, you will continue to maintain your credit worthiness throughout the process of finding a home. But again, the pre-qualification is not a guarantee, but it should tell the it'll tell your real estate agent that you are qualified to purchase this home, your credit and income information has been reviewed, and that you're prepared to shop for a home.
Right. And Wayman, let me chime in real fast. With most realtors, almost all, with the housing market now, they really want a pre-qualification letter to show a house. You know, they want to make sure that the borrower is serious and that will qualify for some type of loan program.
Yes, that is 100% correct. And it's also important to stay up to date as far as your pre-qualification is concerned. And an example of that is over the past couple of months, we've seen and I'm sure you all have heard about this on the market, we've seen an increase in interest rates. And with that increase in interest rates, there are situations where borrowers who may have been qualified previously based upon their credit and income and their debt to income ratio, they may no longer be qualified because the interest rates have risen and they may have been priced out of that particular dollar amount of a home. So that's why it's always important to stay current on that, stay in contact with your loan officer to get interest rate information updates. So just so you know what's going on in the market. Okay.
That's a great point.
Yes. Okay. So the next step you want to do is obtain your pre-qualification, as we talked about. With that, you're going to discuss the loan rate, terms, options, and fees, whether you're going to go with FHA, VA, or conventional loan. You'll also want to provide the copies of your income documents, which in most instances is going to be 2 months, or I'm sorry, the 2 most recent pay stubs, which is going to be 30 days of pay stubs, 2 years tax returns, and 2 years W-2s. Okay. We'll review your credit. We'll be able to discuss things that are on your credit that may be causing issues and just things in general. Okay. Just so we both are on the same page as far as your credit is concerned. Student loans, one thing that is really a hot topic as far as student loans is going to be income-based repayment plans or forbearance plans. Okay. There are different guidelines for student loans depending on what type of loan you have. Okay. For example, if you have a conventional loan and your student loan is reporting 0 or in a forbearance, then that payment may not necessarily have to count in your debt to income ratio. Whereas with an FHA loan, no matter what the credit report states, they're going to count some payment towards that particular debt. Now, one of the big benefits with the FHA that has changed over the past 6 months is that they have agreed to calculate all student loan payments at 0.5% of the balance. Previously, it was 1% of the balance. So that 0.5%, it gives the borrower additional buying power. So that's a great benefit that the FHA has come with over the past 6 months, and it's definitely helped a lot of buyers. Disputed accounts on credit. One thing in regards to disputed accounts, those are typically accounts that you've seen on your credit that you do not agree with that particular creditor in regards to. One thing I want to point out in regards to that is that disputed accounts typically have to be removed in order for us to be able to proceed with the loan. So which leads to another topic as far as credit repair. There are a lot of credit repair companies out here that offer that service for a fee. And a lot of times what they do is they dispute those accounts. When an account is disputed, it may result in a slight increase in the credit score. But when it gets to the mortgage lender is going to advise you that that dispute would have to be removed. And once that dispute is removed or cleared up, it may result in a decrease in the credit score. So that's one thing to be conscious of when it comes to disputed accounts, credit repair companies, and things like that. I would just advise, as a rule, not to get involved with any type of credit repair that's going to involve you paying a monthly fee. The reason being is because there are a lot of nonprofit organizations out here that offer that service free of charge. They'll counsel you on what it is that you need to do in order to improve the credit. There's a lot more one-on-one reaction, a lot more customer involvement, which allows you to understand what's going on with your credit. Okay, so any company that's going to be charging you for a monthly fee for repairing credit, I would try to avoid. All right. So this next slide, we're going to talk about available loan programs. FHA is the federal, that's the acronym for the Federal Housing Authority. Those loans are typically looked upon as being first-time homebuyer loans because they have a smaller down payment requirement. FHA loans have a minimum down payment requirement of 3.5%, whereas with a conventional loan, typically your down payment is going to be 5%. There are some instances where you can do a 3% down payment with a conventional loan, but that's going to more so depend upon that particular property, your income, and the overall income of the area. Okay. So government sponsored, Fannie Mae and Freddie Mac. Those are going to be the two conventional loan programs. Most banks do offer portfolio programs, which may be a benefit if your loan program or if you do not fit within any of the other guidelines that the FHA, VA, Fannie Mae, or Freddie Mac provides. Okay, so those are your loan options that are out here. FHA, VA, Fannie Mae, Freddie Mac, and as you can see, the government is heavily involved in the mortgage business, in the mortgage industry. So that's another point that I should make at this point. When you hear things like underwriting guidelines, the government makes those guidelines. Okay.
Yes, so they do.
We as banks, we have to follow the rules of the government when it comes to lending, and as you can see, the government heavily involved in FHA, VA, and Fannie and Freddie. Okay. Anything you want to add to that, Doug?
Yeah, we're kind of the middlemen here as far as making sure everything is up to their standards and making sure all the I's and T's are crossed as far as on that end. But we're definitely not the bad guys or girls here on the underwriting. It's strictly them. So yeah. That's 100% correct.
Yes, sir. We are definitely the middleman. We are the relayers of information. The underwriters interpret those guidelines, and we just pass it on to you all as best we can.
Right.
Okay. Okay. So again, we'll talk a little bit about the FHA loan. I mentioned before, they typically require 3.5% down payment. For purchases, you can go as low as a 600 credit score. Some benefits of the FHA loan is that there are a little less strict factors when underwriting as compared to a conventional loan. One example is in regards to bankruptcy guidelines. For an FHA loan, providing all other things are lined up properly, you can get an FHA loan after 2 years, after a discharge of 2 years for Chapter 7 bankruptcy, okay? For Chapter 13 bankruptcy, 1 year, and satisfactory repayment can qualify you for an FHA loan, okay? Couple of other things as far as FHA loans, they do have an upfront mortgage insurance premium that's required on all FHA loans. And what that does is that adds a little additional closing cost to the loan, okay? And it also has the monthly mortgage insurance, which mortgage insurance is required on all loans when you have less than a 20% down payment. But for FHA loans, it's going to be required on that type of loan regardless. Okay, so if at all possible, if you can qualify for a conventional loan, that's going to be an overall less expensive loan as compared to an FHA loan, but FHA loans are not bad at all. Because a lot of times as first-time home buyers, we don't necessarily have our credit situation as favorable as we would like, but that doesn't necessarily mean that you can't qualify for a loan. The FHA does allow you to do that, and then eventually the goal or the plan would be to maybe refinance from that FHA loan to a conventional loan so that you no longer have the private mortgage insurance. Okay, and then the last point as far as FHA loans are concerned is you can qualify for an FHA loan 3 years after the foreclosure completion date. Okay, So what we'll do next is we'll compare the FHA loan to the conventional loan. Again, conventional loan, just start at the first bullet point. You can go as low as 3% down payment up to 20% down payment. Again, that 20% down payment will prevent you from having private mortgage insurance. However, as you can see, the credit score requirement on a conventional loan is a little bit higher than the FHA loan. Along with that, you're going to have more strict underwriting guidelines for a conventional loan. A couple of examples of that. Take a look at the bankruptcy guideline. 4 years on a conventional loan versus 2 years on an FHA loan. 2 years for Chapter 13, 1 year for the FHA loan. Okay, so those are a little more strict underwriting guidelines as it pertains to bankruptcies. Now, one other important point, there is no upfront mortgage insurance on a conventional loan. Even if you don't have a 20% down payment, you will not have that additional mortgage insurance premium as a part of your closing costs. But you will have a monthly mortgage insurance, which brings your credit score into play at that point. Mortgage insurance is based on a number of factors, credit score being one of the main factors. For a conventional loan versus an FHA loan with a lower credit score, the conventional private mortgage insurance is going to be a little more expensive. That's why it would be beneficial to go to an FHA loan, because you're more likely to get a lower interest rate and lower mortgage insurance premium with a lower credit score than you would with a conventional loan. Okay. Last bullet point, you can do a short sale requires 2 years waiting on a conventional loan versus 1 year on an FHA loan. Okay. All right. So again, we'll talk about the benefits of the FHA loan. Low down payment, again, minimum 3.5%. Low interest rate, even with the lower credit score. If you have a lower credit score with a conventional loan, you're not going to get a lower interest rate. That's just not going to happen. Whereas with the FHA, because their underwriting guidelines are a little more forgiving, you can obtain a lower interest rate with that loan. You're able to do gifts for the entire down payment amount of 3.5%, whereas with a conventional loan, you do have to show some of your own funds. Down payment assistance programs are allowed with FHA loans, as well as conventional loans, but that's one misconception, is that you may not be able to qualify for any down payment assistance if you have an FHA loan. Doug, anything you want to add?
No, that's, I mean, spot on. Again, I think you said it. Conventional, no, if at all possible, that's the way to go. But I mean, life happens. You start out. Sometimes you have to go the FHA route, but no, it's still a great loan program. It really is.
Yes, 100% agree. Everyone may not qualify for conventional loans, but that does not reflect negatively, because there are other loan options for you. All right. A couple of benefits as it pertains to conventional loans. You have no mortgage insurance with a 20% down payment. Again, I mentioned earlier, no matter what your down payment is with an FHA loan, you're going to have that mortgage insurance. And then you also have the lower costs for conventional loans. And again, that ties back into that mortgage insurance premium that's required for the FHA loans. Because you have to collect a portion of that upfront, that makes the FHA loans a little more expensive than conventional loans, but not bad loans at all. Okay. So next, we're going to talk a little bit about programs for first-time home buyers. Got low down payments. Seller can help with closing costs. You have VA loans, and we mentioned VA loans briefly earlier. VA loans are going to be loans for veterans. The benefit of VA loans is that, and I'm sorry, they're for veterans, surviving spouses of veterans as well. Okay. Benefit of those loans is that you can qualify for 100% financing. No down payment is necessarily required for a VA loan. So that's the biggest benefit for being a veteran. As far as the mortgage process is concerned, is that, you can qualify for that particular loan. And along the lines of the FHA, VA loans are, probably as equally as forgiving as FHA loans as far as credit scores, debt to income ratio, and things like that. Okay, so, but that's a benefit for being a veteran of the armed forces or the surviving spouse of a veteran.
If we could pause for just a moment,
Sure.
We do have some questions.
Okay.
Do you want us to wait until the end, or can I ask a couple of them now?
No, we can do that now. So
Yeah,
that we
that's
don't have
fine.
to wait. Yep.
Yeah.
So regarding the credit score, I think you explained that the score doesn't matter as much as what's in your report. Are we clear on that?
Well, the credit score, it does matter
Yes.
because there are minimum credit score requirements that we have to meet. Okay, but it takes in conjunction the credit score as well as what's listed on the credit report. The things that are on the credit report are actually going to be an indicator of the score.
Right. Okay. That's clearer. Yes. Thank you. And also the income to debt ratio. Is there just a general guideline when you think about how much money you make versus how much money you should even try to purchase a home with? Is there some kind of guideline for the buyer before they even start?
Well, the common debt to income ratio calculation is going to be 45%. And when I say that, what that means is no more than 45% of your monthly income can go out to pay your mortgage debts. And, the best way to calculate that is monthly income versus monthly debt. That lets you know where you stand. That's the type of calculation that we use.
Okay.
Yeah, in that category, the lower the number is better, but
that's correct.
Okay.
Additional assets, 401ks, IRAs, bank account information can assist if you're on the borderline, as far as your debt to income ratio. If you're close, the higher the debt to income ratio, the more assets you would like to document, because this is a desktop underwriter approval system. So the more assets you have, the better it looks.
Okay. You answered several of the questions right there.
Okay.
And another question that came up, does the bank have any suggestions for grants to help with the down payments and or closing costs?
Yes, we do. Actually, Carrollton Bank, we have a niche program, and we're going to talk a little bit about that later. We definitely have our own down payment assistance program as a bank. And then we work in conjunction with several community organizations that also offer down payment assistance. The great thing about our down payment assistance program is that it can be used in conjunction with any other down payment assistance program that a nonprofit organization offers. We can't use it in conjunction with another bank, but it has, with any nonprofit organization, it can be used on top of that. Okay, so that's a good benefit as far as our program is concerned. And one thing, if you qualify for our program, you should qualify for any program that the nonprofit organization, any down payment funds that they have, because we all have to use those same HUD income limits.
Okay. And then the last one that has come up, can you clarify the difference between mortgage insurance and homeowners insurance?
Okay. Mortgage insurance, Doug, you want to take that?
yeah, I was going to say, so for mortgage insurance, we talked about on the conventional side, anything above 80% loan to value has to have the mortgage insurance. You might hear it as PMI, mortgage insurance, MI, but anything above the 80% has to have the mortgage insurance. And homeowners insurance that is required as well. That is if there's any kind of a fire, theft, tornado, that secures our collateral as far as nothing happens, as well as as you as the homeowner. So that's the difference between the two there.
Okay, thank you.
Yeah, the only thing I would add is that the private mortgage insurance is insurance for the lender in case something happens in regards to the loan. In case the loan is defaulted, private mortgage insurance covers the lender. Homeowners insurance is going to cover you if there's damage to the house, as well as the lender, because the lender needs to make sure that the home's standing and in good shape. Okay, so that's the only thing I would add in regards to that.
That's it in a nutshell, and that's very helpful.
Okay.
Yeah.
Okay, that's all the questions we have at the moment.
All righty. And so we'll go ahead and we'll talk about some of the down payment assistance programs that are out here. And this kind of piggybacks on one of the questions that were in the chat. We work with approved nonprofit agencies, and just to name a few, you have Better Family Life, Beyond Housing, the Urban League. And what they do with the mortgage lenders is that they'll let us know when they have funds available. And most funds are available at the beginning of the year because that's when, and this is all kind of grant government money. That's why the government is so heavily involved as far as setting the guidelines in regards to the income and household size, because this money does come from government entities and it's passed on to nonprofit organizations, and they distribute that money to people who have been deemed needy of that money. Okay, so that's why, a lot of the guidelines are in place, because that is federally funded money. Okay, so we work with approved agencies. Our program is Down Payment Plus, which is our private bank program. FLHB, that's the Federal Loan Home Bank of Chicago. That's where we get our down payment assistance funds from. Okay, and we'll talk a little bit more about those programs going forward. There are also other programs available: MHDC in Missouri, IHDA in Illinois. Those are state down payment funded programs. Those two programs, the gist of those is that they offer 4% of the purchase price towards the down payment and closing costs. And then also you have your local city programs and county programs: Better Family Life, Beyond Housing, Urban League. Those are a few examples of who we also work with our down payment assistance programs. Pretty much what we're seeing now is that you do need a middle score of at least 640 in order to qualify for those programs. And when I say qualify, what has to happen? You meet the credit guideline, you meet the income and household size guideline, and then at that point, we're able to submit your file to a desktop underwriter approval. So basically, we submit it to the computer, we get the approval. That means you qualify for that. Now, we still have to go through the process of verifying that income, and we verify the household size. So there's going to be some documentation that'll have to be signed in order to verify that information. But in most cases, you do need at least a 640 credit score to make sure that you qualify for those programs. This next slide, what we offer from a down payment perspective, or our program, it's a matching program. And what we offer is a $6,000 forgivable grant that goes on title, and that $6,000 can be used towards the down payment and closing costs. Your minimum contribution has to be $1,000. And that $1,000 can be in the form of your earnest money. That can be in the form of you paying for inspections, and things of that nature, but that has to be your minimum investment. For that $1,000 investment, you'll get $6,000 from Carrollton Bank. And what happens is that $6,000 lien is on title for 5 years. After that 5-year period of time, that lien drops off. Okay, so that is our niche down payment assistance program. And again, if you qualify for this $6,000 program, and you work with some of the other nonprofits, they may offer a $3,500 grant, $3,000 grant. Some of them offer $5,000 grants. our grant can be used in conjunction with that. So there are times where people do qualify for upwards of $10,000 in down payment assistance, which can really go a long way. And that's a huge benefit. And one other thing in regards to that, we get this money every year. It comes in typically January, February at the beginning of the year. And then in most cases, those funds are exhausted by the summer. So I think last year, due to COVID and the market kind of slowing down and people having trouble finding houses, the money lasted until September. But typically June or July is when those funds go, because we service a number of customers for that. So that's our niche program as far as down payment and closing costs. So now we'll get into a little bit of the qualifying piece for the down payment programs. So in addition to the credit score requirement that we talked about, there are guidelines as far as your income and household size. Now, you see these numbers here on the right, you have your gross income, and on the left, you have the household size. So these guidelines were updated as of last year. They have not come out with the new income limits, but you read above here, the household income limits were last updated in April. Income limits set by the U.S. Department of Housing and Urban Development. So again, government makes those guidelines. We have to follow those guidelines. So one person household, $47,750. That's what you would qualify for. Two-person household, again, a two-person household can be a mom and an infant child, mom and a teenage child. Anyone that's in the household with you is going to be taken into consideration for the household size. Now, again, it's your total household. So if you have, let me just give you an example. If you have a married couple, but you only have one person that's applying for the mortgage, maybe because the other person's credit isn't where it needs to be, but that one individual can definitely qualify and be able to purchase a mortgage based upon their debt to income ratio and other qualifying factors. We still have to take into consideration the income of that other person. So if there's just one person on the loan, but two people in the household, we still have to take into consideration that household income. That household income may disqualify them from that program. Okay. So, again, these are not Carrollton Bank or any other bank's guidelines. These are the guidelines that are made by HUD. And we, again, have to follow those guidelines. Want to add anything to that, Doug?
No, I'm just, we definitely have to follow them.
Yeah.
So,
Yeah, there are some instances where we have to come back and verify information after a loan is closed. That's not what we want to do, because that can put us in a situation where we have to pay that money back because the money's gone. We've already given it to you. And if we didn't do our due diligence, then that can put us in a tough situation. Doesn't happen often, but it happened. It has happened before.
Right.
Okay.
This screen is a little bit confusing, and just to clarify for people, if you're one person, you can't make over $47,750, or you can't make less than $47,750.
You can't make over that amount.
Over, right.
Okay.
Okay. Anything in the chat? Okay.
Okay.
So this next flyer is going to be in regards to MHDC. That is the Missouri Housing Development Corporation. And what we use this program for is in the event that, again, going back to this slide, MHDC would be for a one-person household whose income exceeded that amount. So if your income exceeds this amount, there's still some down payment programs out here for you, which would be MHDC is one of the programs. That's the Missouri Housing Development Corporation. That's going to be for the Missouri side. Okay. They have their own set of guidelines as far as income is concerned. Income limits are higher than the income limits for the HUD programs. The only caveat or only bullet point I want to point out in regards to MHDC is that they set their own rates, okay? Whereas, you know, the banks have their own conventional rates, FHA has their own rates, MHDC sets their own rates, and typically their rates are a little bit higher than the conventional rates. And the way that I look at it is, I guess that's the trade-off, because this is a state-sponsored program. That's the trade-off for that down payment assistance that you'll receive. Okay. And let's see. Next up, we have the IHDA program. And what that is, that's the Illinois version for the down payment assistance program. Again, if your income limits exceed the HUD income limits, there are options out here that will allow you to qualify for those programs. And pretty much the MHDC and the IHDA program, just note that they offer 4% of the purchase price towards down payment and closing cost assistance. Okay. And those programs, again, are in place for individuals whose income may exceed the HUD limits. Okay. Just note, IHDA and MHDC do set their own rates, and we just have to go with whatever they offer. Okay, here's some additional guidelines as far as down payment assistance. Again, you must meet the income and household eligibility requirements. You have to contribute at least $1,000 to the purchase of your home. You have to participate in a home buyer and financial literacy counseling. Okay, now with those nonprofit organizations that offer down payment and closing cost assistance, they also offer home ownership counseling and financial literacy counseling. And typically what that involves is probably, there's an online course that you take that takes about an hour or so. And it's pretty much you going through that course and confirming that you understand the home buying process, what it entails, what you're going through. There's going to be information in regards to getting home inspections. There's going to be questions in regards to private mortgage insurance, mortgage payments, and things like that. So this is them basically confirming that you understand what you're doing. Okay. And the last and probably the most important thing, you have to live in the home as your primary residence. Down payment assistance programs are not available for rental or investment properties, not available for second homes, strictly available for your primary residence. So that has to be your home. Understanding also there are circumstances where, you know, you may have to move after you purchase a home. There's not going to be a recapture of those funds because it's going to be a smooth transition from you moving into the next residence. Okay, but for the purpose of qualifying for down payment assistance, this has to be your primary residence. Okay. Now, one other thing, the second bullet point, for most of the down payment assistance programs that you can qualify with the nonprofit organizations, they also require a minimum of $1,000 investment on the borrower's behalf. The good thing is that that $1,000 that anyone requires, it's the same $1,000. So it's not as though Carrollton is going to require $1,000, the nonprofit is going to require $1,000. So, you know, $1,000 flat is your minimum investment. Okay. So given certain scenarios, that can be your only requirement or your only investment. And, you know, you can get into a house maybe with as little as $1,000 out of pocket. I've seen it happen quite often. Okay.
That's just amazing.
Yeah, I know, and I can testify to that. You know, seriously, probably about a month ago, I had a guy that brought 53 cents to closing. They couldn't get it to $1, you know, they couldn't get it below that, but his out-of-pocket investment was $1,000 total, and the 53 cents is what he had to bring to closing. Okay.
And this is so helpful. So many people think there's just no way they can ever buy a home.
No, there are options out here. I
Mhm.
always recommend explore your options, talk to a loan officer, ask questions. That's all a part of the pre-qualification process. Even if you're not looking for a home immediately, it's always good to know where you stand. You know,
Sure.
I can't
Absolutely.
tell you how many people start the home buying process and they're ready to buy a house tomorrow, but their credit doesn't indicate that. Okay.
Mhm.
Doug, you want to chime in on anything?
Yeah, I mean, yeah, like we were just talking about some of these programs. I mean, some people just don't know about them. And I mean, like you said, talk to a loan officer, research it. I mean, the more you know, knowledge is power. I mean, and take full advantage of these programs because they could really, really change somebody's life. They really can.
Yes. Share information. If you have questions, ask questions. That's
Sure,
the best
absolutely.
information I can give. In this last bullet point, you can qualify for up to $3,000 to $15,000 in funds. I've seen it. I've seen instances where we've used our down payment program of $6,000. We may have gotten an additional $3,000 from a nonprofit organization. And then on top of that, they went with the Missouri Housing Development Corporation and got an additional 4%. So there are instances where you can really line it up and you can have these things work to your advantage. Okay, so the next slide is we're going to talk about steps to obtaining a home loan. Again, the first thing that you want to do is apply. You want to provide the documentation that's required, pay stubs, your income and asset information, basically. Once you've provided that documentation, your loan officer should be able to issue a pre-qualification letter, which at that point you'll be able to pass to your real estate agent. Always recommend connecting your home loan officer and your real estate agent together so that they can get any questions answered. Real estate agents, they definitely have a lot of questions for lenders, and sometimes lenders have questions for the agents. But again, going back to Doug's point earlier, getting pre-qualified and having that letter in hand is probably the most important thing that real estate agent is going to be looking for, because they need to know in this market that you are qualified to purchase the home that you're looking for, because things are so competitive right now. Once you find that home, we're going to do that. That's kind of when the process starts. Once you find that home, because at that point, we're going to order the appraisal, title work, and, providing the appraisal and title work comes back clean. Underwriting is going to review everything for final approval. Then you move on to the loan closing process. Okay, and we'll talk a little bit more about that going forward. But our next thing is we're going to just review some different mortgage terms. Okay, anything in the chat?
I do have one more quick question before we move forward. The income limits from the slide, are they limits for HUD loans in general or for HUD down payment assistance programs?
That is strictly for HUD down payment assistance.
Okay.
Okay. You can qualify for, your loan, your income and debt is going to determine what size loan you qualify for. And the income and household size will determine if there's any down payment assistance options for you. Okay. All right. So let's see. This first slide for the vocabulary is going to be offer. Okay. An offer is going to be an agreement between a buyer and seller to purchase real estate, also referred to as the sales contract. Okay, so once you have found a home that you like and you're ready to write that offer, that's when your agent's going to basically complete the sales contract, have you sign that sales contract. They'll forward that sales contract to the seller's agent and hope for the approval. Okay, so that is you offering to purchase the home at the price that you see fit and the terms that you see fit. In that offer, it's going to contain your purchase price. It's going to contain whether or not you're doing any earnest money. It may contain some loan program terms. It's going to let the lender know the contingency date, which is our next slide. And it's also going to let the lender know the closing date, what the contract entails, if there are any items that are going to be included, is there going to be a home warranty. All of that information is contained in the sales contract, which kind of leads me to my next point. When it's important to have a comfort level with your real estate agent, with the person that you're working with, because they're helping you to make a huge decision in your life. And you definitely want someone that's vested in your, having the best situation for you. You're just not looking for an agent that's looking to make a sale, make a profit, because they have somebody that's willing to purchase a home. So with all that being said, your agent should put their best foot forward as far as writing an offer to make sure that that offer suits what your needs are. Okay, so make sure you're comfortable with the agent. Interview agents, talk to agents. Just make sure you're comfortable with them. You want to add anything to that, Doug?
No, you're spot on. I mean, having a good agent is so helpful. There's some really good agents out there. So I mean, that's another thing. I would do your homework. I mean, if you knew somebody, family member that had a good experience, good referral from a friend or a coworker, I would definitely check out that agent before you use them. And but they are key. They can really be helpful.
Mm-hmm. Yeah. And another thing to add to that, I mean, a lot of the sales that are going through now are relationship. It's based on the agent and the relationship that they have in the market and their ability to just work their deals. So it's always important to make sure that you have a good agent. Okay, contingent. This is going to be our next mortgage term, or our next term for this slide. After an offer has been accepted, finalization of the closing can be contingent on certain terms, such as the inspection, the appraisal. Title work shouldn't be an issue, but typically when an offer is contingent, it's contingent upon, there being a satisfactory inspection, home inspection, when you hire someone at your cost to inspect the home, to make sure that everything is up to par, so to speak, or to your satisfaction. They're going to go in, the home inspector is going to go in, and a good home inspector, they're going to pretty much go through every aspect of the house. Yep. I mean, I don't think home inspectors really have a good reputation with sellers, but that's okay. They work for the buyer, and that's all right.
Yeah, they're not the most well-liked person.
Yeah. And typically your agent's going to be not necessarily tied in, but they'll have an inspector that they work with, that they're comfortable with their level of the professionalism that they provide and the service that they provide. So yeah, that's one thing that I always recommend. You're seeing instances now within this market where you might have individuals that are waiving inspections or just doing inspections for their own internal notification. I would always do an inspection. I mean, let's be honest, buying a house is probably the biggest purchase that any of us is ever going to make. So do that inspection, know what's going on with the home, because the last thing that you want to do is skip the inspection piece, and 3 weeks after closing, something happens, and it could have, there's a big rain, the roof leaks, basement gets wet, and those are all things that could have been found in the inspection, that maybe the roof was leaking, or maybe the basement was prone to having moisture. Those are things that can be found out during the inspection period, but you skip that, and now you're going to pay for it later. So
I can't imagine not having an inspection and then the house rolls down the hill. I just can't imagine that.
Yeah. And as a protection, a lot of the down payment programs do require inspections. Now, our program from Federal Home Loan Bank of Chicago does not require that. But, the nonprofits, they're going to require an inspection, which I think is a good thing. It's only to protect you. You do have to pay for it, but it's for your protection. The benefit also of that is you paying for your inspection goes towards your $1,000 contribution. So just for example, say you found a home, you qualified for down payment assistance, you paid $500 in earnest money, and you paid $500 for an inspection. In theory, you can be done. That's your $1,000 expenditure that's required by you. Now, provided everything, all of the other numbers work out, that can be the only thing that you're required to pay out of pocket, because you will get credit for that earnest money, and you'll get credit for that inspection. One thing I want to point out, you always want to use a debit card or write checks. When you're doing your earnest money or when you're paying for inspections, don't use a credit card, because most down payment programs cannot track that. You can track a debit card spending because you'll see that coming out of your account. It basically, they have to confirm that you paid for it. And the confirmation is, if it's coming out of your checking account, then it's paid immediately, versus a credit card, it's not necessarily paid immediately. They can't track that. Okay. So you always want to pay using your debit card or a checking account.
You need to stay away from your credit cards anyway when you're buying a house.
Oh, yes.
Hey, very good. Yes.
You're
We'll touch on that later. We'll touch on that too. Yeah.
That's it.
Yeah.
Okay. And then this next slide is just out-of-pocket costs. We just talked about those previously. In earnest money, that again is going to be what you are going to put down towards the purchase of the house, not your down payment. Your earnest money is pretty much your good faith gesture saying that, yes, I want to purchase this house and I'm willing to put this much towards that. Earnest money can go anywhere from $500. It's typically where they start at, up to, I mean, I've seen some with $3,000, $5,000. Those are larger loans. Typically, earnest money is anywhere from $500 to $1,000. For most of our first-time home buyers, it's probably going to be $500, I would think. Okay, and then the inspection, we've talked about that. That's the inspection that's done for you to let you know what's going on with the house, any structural things, just the ins and outs of the house. The appraisal, that's the third thing. The appraisal is what's going to determine the value of the house. That's where you have an independent third-party appraiser that, you know, we choose the appraiser because they have to be approved appraisers with that particular bank. So each bank is going to choose what appraiser goes out. Now, they don't handpick the appraiser. Most banks just click a button and order the appraisal, and it's sent out. It's called centralized appraisals. So what happens is we just order the appraisal in our system, and they shoot this appraisal order out to a number of different appraisers, and whoever is available, they'll pick that appraiser. Okay, so what that does is that keeps the lender from directly contacting the appraiser. The lender doesn't have any impact or any influence on the appraiser. Neither does the borrower, neither does the seller. So the appraiser is strictly independent, third party, but he has to be hired by the bank. Okay, and what that appraisal is going to do, it's going to tell you the value of the house. Okay, and Doug, you want to jump in and anything in regards to that?
Yeah, no, I mean, you're spot on with the appraisal system. I mean, it's a rotation, boom, so there's no collusion, that they can say, hey, the realtor and lender work together. So, and it comes back at a fair value, based on the comparable home sales in the area. So it actually benefits everybody.
Right, that's correct. And again, Doug just said it's based on the comparable home sales, and what that is, that's homes like the one that you're looking to purchase. So if you're looking at a 3-bedroom, 2-bath house, they're going to compare your house to other 3-bedroom, 2-bath houses that have recently sold. They're not going to compare your 3-bedroom, 2-bath house to a 1-bedroom, 1-bath house. They're definitely not going to compare it to a 5-bedroom, 5-bath house. Right. So it has to be a house like yours. And what that does is going to give you the true indication of the value. Now, I'll just mention this briefly because I have to speak to what's going on in the market. In a lot of instances now, you're seeing people bid above what the appraised value is. That's certainly your option. As a loan officer, it's kind of hard for me to understand, but I get what's going on in the market. A lot of what's going on in the market is hard for a lot of the professionals that have been in this for a while to understand, but we're just accepting it. But your appraisal is going to give you your true value of the house. Okay.
Another question, would you recommend working with housing counselors? We see HUD.gov has some kind of counseling, homeownership counseling.
Yeah,
Do you
yes.
recommend
The thing about that, if you're going to qualify for down payment assistance, you're going to have to go through that process anyway. And so I wouldn't recommend doing that up front. Now, unless you already know of a nonprofit organization that have funds available and they've already qualified you based on your income, but your lender is going to be able to direct you on the counseling agencies that are available in the area. It's nothing that you would have to go through up front, especially if there's a fee associated with it. If you're doing it for your own knowledge, then that can be fine, but I definitely wouldn't pay for anything up front.
I'm sorry, there's another question. How many months of credit would you need to be qualified for a home loan?
In most instances, you need 6 months.
I was gonna say.
Yep. Go ahead, Doug. I'm sorry.
Yeah, I'm sorry to interrupt you, but I was just thinking that it was popping out right when you were saying 6 months. So yep, I agree with you 100%. So
yes. Yeah, and that's going to be active trade lines. You don't have to have a lot of credit. You just have to have enough to generate a credit score, which why it's important, going back to the first slide, it's important to know where you stand as far as your credit is concerned. But to answer that specific question, 6 months is the minimum. Anything else here?
Yeah, any other questions or?
I don't see any more questions popping up.
Okay.
But that could change.
All right. Okay, so the next slide again, the inspection, that's the examination of the home for its condition. It's handled by a licensed professional of your choosing. Again, most real estate agents have a number of inspectors that they've worked with, so that should be information that they should be able to provide to you. You're able to call, check their availability, check their pricing, see what inspection services they offer. But again, this is something that's done strictly for you so that you know the condition of the house before you purchase it. And one thing about inspections, if your real estate agent has included in the contract an inspection contingency, then that means once the inspection's done, if there are things on the inspection that you absolutely do not like and that they are making you not want to purchase that home, then that inspection contingency will allow you to walk away from that deal and maintain your earnest money that you put down. Because again, you've already written a check to the title company for the earnest money, which is letting them know that you're really interested in purchasing this home. The contingencies that are in the contract are things that could allow you to walk away from that contract and still keep your earnest money. Okay, so inspecting contingencies, appraisal contingencies, those are all, contingencies that are common in contracts. Okay. Closing costs. Closing costs are fees paid at the day of closing by both sellers and buyers. These fees can cover lender expenses, taxes, and insurance. Okay, so not only will you as the buyer have closing costs, those closing costs are going to consist of title insurance, your appraisal, you have to pay for the credit report, their flood certificates, they're different fees that you are responsible for paying as the buyer. Now, the good thing is that those fees are all disclosed to you initially on our loan estimate. When you sign that original loan document, all of that information goes out to you. You're able to get a breakdown of the fees that could be associated with the loan. Okay. Now, as far as the seller paying closing costs, seller is going to be responsible for some items such as taxes. such as water, sewage, things like that, from the time up until the day they sell the property, they're responsible for that. So I'll give you an example. If you are purchasing a home on the 1st of December, that particular seller is going to be responsible in Missouri. They're going to be responsible for the previous 11 months of taxes. You're responsible for taxes from the day you purchase it moving forward. They're responsible for taxes from the time they sell it going back. Okay, so there'll be credits on the settlement statement for seller paid taxes, typically MSD and things like that. Doug, you want to add anything to that?
No, you're
Okay.
spot on. I mean, as far as that, I mean, it comes down to the closing, and like you said, there's certain prorations and there's certain credits that you may get, and so
Okay.
that's just
And
how it works.
yeah, by law, mortgage law, you have to disclose those closing costs at least 3 days before closing. Okay, so you'll know what your closing costs are, what you're responsible for bringing to closing at least 3 days before closing, and those funds typically have to be brought in the form of the cashier's check. If they're lower amounts, then personal check may be available for amounts under $100. That really depends on the title company, and you can check that with them. But the closing costs are the fees that are paid the day of closing. That's your bottom line number is going to include your closing costs as well as any down payment that you were responsible for. So that's going to be the money that you bring to closing. Okay, title. Title is going to be the bundle of rights for a property, which will be handed to you by the title company to accept. So basically what happens when you agree to purchase a home, there's title work that has to be done. Probably the easiest and brief description of that is to make sure that there are no additional liens on the title. You're the only owner. Once you purchase a home, the only thing that should be on title is going to be your name, the bank's name, and then any down payment assistance programs that are out there if their liens are secured against title. That should be the only thing on title. Okay. All right, so we'll just go through a brief example of estimated payment and cash to close, kind of based on today's interest rate information. So having a sales price of roughly $135,000, approximating today's interest rate. Total monthly payment. Now that total monthly payment also includes an estimate for property taxes and homeowners insurance, which I would advise to always, for most first-time home buyers, you're going to have property taxes and insurance as a part of your mortgage payment. So that's always going to be the case, pretty much. Your monthly payment should include the taxes and insurance. The reason being is because it's a lot easier to make that one-time monthly payment as opposed to having to pay a lump sum for insurance, whatever it's due, or a lump sum for taxes whenever they're due. Okay, so I would always recommend, just from an ease and peace of mind perspective, to always keep those taxes and insurance as a part of your mortgage payment. Okay. So this was just an example of what this particular buyer would have to come out of pocket with. They were estimating about $2,500, of which they probably already paid the $1,000. So $1,500 out of pocket should allow them to get into that home. All right, so here we go. This is our last slide here. And these are the 10 commandments of buying a home. And I would definitely pay attention to these, and I can probably give you an instance where something happened that kind of derailed the loan program. Okay, so the first thing is you should not change jobs, become self-employed, or quit your job during the home buying process. One kind of asterisk to that, it's okay to change jobs if there's no gap in employment. You know, depending on the loan program though, you know, there are some instances with an FHA loan where they may require a full 30 days of pay stubs before closing. There are some times where they don't. To keep things simple, recommend no changing in jobs. You definitely don't want to become self-employed. If you become self-employed, you've pretty much kind of killed the deal. The reason being because for self-employed borrowers, they're totally different income requirements. 2 years tax returns, business and personal, we got to make sure you cash flow, and no more pay stubs and W-2s. So if you decide, you know, that you want to become self-employed in the middle of the home buying process, just know that that home buying process is going to end at that point. Okay.
Definitely will end. Yes.
Yes. I mean, I've seen it happen where people have changed jobs. The worst thing that's happened to me, we had to delay closing while we waited on additional pay stubs. I haven't had one just absolutely kill itself, but you know, that's the quickest way to do it, is becoming self-employed. You don't want to buy a car, truck, van, or motorcycle. At that point, based on this, I would say if you're really in the home buying process, you don't want to buy anything. Your main focus should be at least maintaining your debt level, if at all possible, paying it down. Okay. You want to avoid any large expenditures. If it becomes a situation where you're feeling like you need to make a purchase, reach out to your loan officer, relay that information so that you all are both able to make an educated decision.
Mm-hmm.
You know, I've definitely had that happen, you know, where people have bought cars. You know, probably the main thing from a home buying perspective is, okay, we're 2 weeks from closing, you know, my loan's looking good. I'm going to go out and buy some furniture. I'm going to go out and buy some appliances. And one thing that happens in the mortgage home buying process, refinancing process, 3 days before closing, the lender is going to pull what's called an undisclosed debt notification. And what that's going to do is it's going to let the lender know what's going on with your credit at that time. Now, it's not a hard inquiry at all, but it lets the lender know if there have been any inquiries, if there have been any new accounts open, and that can lead to additional questions. If there are inquiries out there, we have to have the questions answered. What's going on? If there's new debt that showed up, we have to take that debt into consideration. So if you were at, you know, pretty close to the maximum debt to income ratio, and you went and you made a pretty big expenditure that puts you over the debt to income ratio, then 3 days before closing, that can cause some pretty significant problems that can impact your ability to have that loan approved.
Absolutely, yeah. And then if you see something, a similarity between the two of us, we don't have any hair, and that is probably part of these 10 items here that doesn't happen a lot, but occasionally these come up, and yes, so that is part of the reason why we don't have any hair.
Yep,
So,
that's it. That's it. Don't want to use credit cards excessively. Let current accounts fall behind. I do have an example for that, not in the purchase process, but in the refinance process. Had an individual, we were set to close on Friday. We pulled the undisclosed debt notification on Tuesday, and it let us know that that borrower was now 30 days delinquent on a credit card. So they went from qualifying to not qualifying. We had to, you know, now it postponed the deal for about a month because we had to go through a process where they had to pay some debt down and do some things to improve the credit score to get it to the point where we can approve the loan again. So those things do happen. Those are real world scenarios. And it was just a situation where it got away from them, you know, and it happened, but, you know, it put us all in a tough situation. You don't want to spend money you have set aside for closing. You know, when you're going through the home buying process, that should be the most important thing. That should be where all of your energy is focused, all of your funds are diverted. You want to make sure that this transaction goes through. You don't want to omit any debts or liabilities from your loan application. Reason being is we're going to find out. I mean, if it's not me, the underwriter is going to find out. It's amazing to me, the amount of information that they have access to. Their property reports that we as loan officers, we as consumers, we definitely don't have access to, where they run name searches and it tells the it tells the underwriters if you own any other properties. Well, if you didn't include that property on the mortgage application, and if that property isn't showing up on your credit because you own it free and clear, it may not be that important to you. But from a lending perspective, it's very important because we have to take into consideration that debt. Even though you own that mortgage free and clear, you still have taxes even though you own the home free and clear, there's still taxes that have to be paid. And you would think that there would still be some insurance that you would have to pay on that particular property. Well, guess what? That has to be calculated into your debt to income ratio. So that means your ratios are going to change a little bit.
And it changes your assets as well.
Yes, it does. That's right. That's right. Again, don't buy furniture. Don't buy the refrigerators. Don't buy the stuff that you're going to need later. Wait until.
What if you need a refrigerator?
Well, you know what? I would wait until after closing. I mean, that's really the best thing. You know, it may be a couple of days. You know, hopefully they negotiated a refrigerator in the sales contract. But if that refrigerator is going to be the difference between you purchasing this home and not, just try to wait it out. Okay.
Good point.
No new credit increase. You know, you don't want to apply for credit. You really want to leave things as they are. You want to leave that credit score right where it was. No additional increase. No large deposits. Now, that's one thing. Hey, deposits are a good thing, right? Well, as long as you can source those deposits. You know, if you're in the middle of purchasing your home and all of a sudden you get a $50,000 deposit into your checking account, which is almost, you know, that's close to what you make in a year. Well, that's going to need some explanations, and chances are, depending on that explanation, we may not be able to use those funds. Okay. So again, check with your loan officer in regards to that. Don't transfer funds or change bank accounts. Leave things as they are. And the last thing, and I don't know if this just pertains to doing mortgages or period, do not co-sign on a loan for anyone, okay? Unless absolutely necessary. You definitely don't want to do it while you're in the home buying process, because for all intents and purposes, a loan that you co-signed on from a mortgage perspective or a lending perspective, it's looked at as your loan. That's really how it's looked at, you know, because if you co-signed on it, if the person that you co-signed with, if they're not able to pay it, in order to protect your credit, you have to. So
you're paying for it.
Yeah.
That's actually number one on my list of commandments.
Yeah. And it probably should be, you know, because that can put you in a pretty big hole, you know, through no fault of your own, just being a good person.
Right.
I have a couple more questions before we stop, and I see your survey came up, so we'll be sure and take that.
Okay.
First question, if we're interested in purchasing a home, our first step should be to visit a lender so that we can receive a pre-qualification letter. Is that correct?
That is correct.
Okay.
That is correct. And before you go to the next question, I just want to, one more thing in regards to that. With the way that the market is, you definitely want to, I would advocate for looking at local lenders. I mean, and this is information that I get from a lot of real estate agents that I work with in the local market. A lot of times the sellers don't want to deal with larger, you know, and I'll just throw this out here, like the ones that you hear on the radio, your Rocket Mortgages, Quicken Loans, things like that. That name doesn't hold a lot of weight locally because the way that they operate. And this isn't a negative on them. They're a conglomerate. They make billions of dollars, so they definitely know what they're doing. But just from a local perspective, it's good to be able to pick up the phone, call your loan officer, get an answer immediately, get a call back within the next few minutes. Your agent is able to reach out to your lender because they may have had a previous relationship with them. They may know of individuals that have worked with that lender before, so they know that they're reputable and they have they're tied into what's going on locally. So I would definitely advocate for working with a local lender. And I'm sorry.
I don't disagree with that. Another question, how long after buying a vehicle should you wait to try to buy a house?
Doug?
Yeah, I mean, I don't know if there's a wrong answer there. It's, you know, let's just use $400. Let's say you have a car payment of $400. You know, your car's getting older, you trade it in, get a similar payment that, you know, that you can afford, that doesn't, you know, don't double your car payment as far as, and then that would put you on the edge of the debt ratio issue. I mean, so make sure if you're going to trade your car in or buy another car, you know, be within your means so it makes sense and you can afford it. But I don't necessarily think there's a wrong answer as far as on that. And unless you know, your car payment's $400 and you're going up to $1,000, you won't qualify. I mean, because you live in a house, you don't live in a car. So that's something you really have to think about. So.
That's right. Yep. That's right. I have told a few car dealers I can buy a house for that payment. You're out of your mind.
Yep.
Also, and I'm a hard sale, so that works to my advantage. Another question, if you use down payment assistance through HUD, is this something we apply for on our own, or will the bank or lender we are going through help with this process?
That's kind of a both answer. And this goes back to what I was saying about dealing with a local lender. A lot of the national lenders, they're not tied into down payment and closing cost assistance locally. What they'll do is they'll say, well, if you can find something, we'll see if we can work with it. Whereas, you know, we're ready and able to react and provide assistance in regards to that. And like I said earlier, we work with a number of the nonprofit organizations and they let us know when funds are available. So we'll be able to say, hey, well, give them a call and see if they have money available. If they say they do, I know who I can contact there to kind of get the ball rolling. They'll provide you with documentation that you'll have to complete and, you know, do your due diligence with them. But we've worked together before, so we each have an understanding of the programs.
It's good advice. Okay, well, that's all the questions we had.
Well, perfect.
Okay. Well,
you guys have been great. This has been so informative.
Okay. Well,
Wayman, thanks again. You're always organized, and he does a wonderful job at these. So thanks again. Okay.
He does.
Yes,
he
I
does.
definitely
Thank you so much.
you all. Appreciate your time. But yeah, if you have any questions at all, feel free to reach out. I'll just go to this last slide here. This is just okay. So yeah, if you have any questions or anything, feel free to reach out, send an email. You have my contact information. But yeah, make sure that you go to the chat, take a look at that survey and complete that. And really appreciate it and look forward to this opportunity again.
We appreciate you. Thank you so much.
Okay.
All right. Thank you.
Okay.
Thank you, Doug.
Take care, Doug.
Okay.
See you all later.
Appreciate it. All right. Thank you. We'll talk to you later. Bye-bye.
Okay. Bye.
Bye-bye.